Hey folks, this video is just to kind of walk you through the USALI departmental schedule and the summary operating statement if we were to do a comparative and a common size analysis. Now, we already did the USAR, and if you watch the videos on Brightspace, you'll see that the example in the for the common size and comparative analysis videos, the video lectures, this is the example that I actually use. So we also did this in class, so those of you that stayed in class would have seen how we complete this, and we analyzed it together in class as well. So for this video, it's just to walk you through it just in case you didn't quite understand the concept of common size versus comparative analysis. And on top of that, we're looking at a hotel now. So you might just be a bit confused at first, but don't worry, we'll go through it. So, common size analysis, we're always looking at one common number, except when we're looking at a USAR income statement or a food and beverage department. This happens to be a rooms department. So remember that we're always comparing each line on our income statement to one common number. That's the common size analysis. And that common number is always going to be the total revenue of whatever income statement we're looking at. In this case, if you take a look, we don't have total revenue, we've got total rooms revenue, but that's okay. That's what we're going to compare everything to right now. So we would divide our $2,593,055, and we would divide that by our total rooms revenue, $3,027,118. If it shows up as a decimal or a number like that, remember we're in Excel, so we're just going to hit the percentage button, and we always want 2 decimal places. So 85.66% of my total rooms revenue came from my transient rooms. That's how we would actually read that, right? And then we would do the same, $387,179 divided by our total rooms revenue, because we're always comparing it to one number. Okay, and then I could go percentage. There you go. Okay, so 12.79% of these rooms revenue came from group rooms revenue. Remember, this is what we call our revenue split. In class, I mentioned you should try and use Excel to your advantage, and we are going to now, because as long as you understand the process, you should start to use Excel. So right away, we can just put 0 here because, well, we don't even have to put anything. There's 0 of our room revenue. We'll do one more. Other rooms revenue, $46,884 divided by our total rooms revenue, and then we'll make this into percentage. On your calculator, you would multiply it by 100, and remember, rule of thumb, always 2 decimal places. Our total rooms revenue is our 100%. Remember that too, right? Whatever we're comparing to, it will always be the 100%. Okay. Now, when I get to front office, my labor, we're still going to only compare it to my total revenue on this income statement, which is total rooms revenue. And then we'll turn it into a percentage, increase 2 decimal places. Now I'm going to start using Excel because we should be. So I'm going to divide my housekeeping by my total rooms revenue. And because I'm always going to do that, I'm going to do my F4, my absolute reference. And then if we use our fill function and drag it down, click the percentage button while we have everything highlighted, increase 2 decimal places, and then we can get rid of all of these that arrived because I filled. Okay? Stop, go back to what I just did, pause it, take your time with it, but you should feel comfortable with that from your DAT courses as well. But now we can see for each line what percentage of total rooms revenue these are. Okay? So we'll do the same here. We'll divide my transient rooms revenue divided by my total rooms revenue for this accounting period. I'll go absolute function. I'm going to use the fill function now. And then I'll make these into percentages and add 2 decimal places. Okay? Remember, if you see pound signs, it just means the numbers are too big for these cells. Double click, and there you go. Okay? And then we'll get rid of any zeros that we don't need here. Okay? And now we can start to analyze it and see what's going on. So out of our revenue, this is just where we can analyze the revenue split. That's all we would do here. And if we take a look, out of our total rooms revenue, 85.5% almost what came from transient rooms. Look at 2012. It's the same. These numbers haven't changed much. Okay, it just means that we had less people come in. We made less revenue. We can't do much about that. Well, we want to find out why we had less people. But as far as where our money came from, or did we lose more money from one segment compared to another? No, it looks like it's pretty consistent from year to year. My expenses. Now, my front office staff used to represent 8% of total revenues as far as my labor cost for them. It's at 12.44%. So that means revenues went down, but I did not adjust my labor. I didn't start to schedule less people. Okay, I did. Okay, and we'll see that in the comparative, but it wasn't enough. Okay, and then my housekeeping labor cost percentage went up as well. So my total payroll is now 26% of my total revenue, where it used to be 16%. So that's a pretty significant change from year to year. So I would probably look at this and go, okay, we need to chat about this. Either put it in yellow or in some kind of red. We really need to chat about this. This as well. This I would be more concerned about, but from common size, I probably wouldn't highlight this. When we get to comparative, we'll highlight it. Guest comfort, this has gone down. Okay, so it's now you can see it dropped by almost a half here. We'll see that in the comparative. But you can see that we actually dropped the percentage, cost percentage. I'm happy about this. I'm happy about the fact that, yeah, you know what? We controlled our costs here. This is good. Laundry, as a percentage of total revenue, it's not too bad. Okay. Training as well, not too bad. Overall, as a percentage of total revenue, I'm almost the same as last year. So I controlled these other expenses, which is good. Okay. My total expenses, though, if you take a look, are 26% of total revenue in 2011. In 2012, they're 36% of total revenue. That means this went up by quite a bit. Okay, so we need to chat about this. But again, we can look at totals. I mentioned this in class, but once we look at totals, we're going to want to look at individual expense lines. We've already done that here. Okay, so this 36.59%, yeah, I'm not happy about it, but we can tell that it comes mostly from labor. Okay, we've already analyzed that. And then overall, as a percentage of rooms revenue, our profit margin, it's gone down. It used to be 73%, well, almost 74% compared to total rooms revenue for this department. Now it's 63%, so we need to talk about that. We're not happy about it, but again, we already know where it comes from because we've analyzed the rest. Now we can do our absolute. Oops. And our relative change. Okay. Absolute change, remember, it's always current accounting period minus previous accounting period, or whatever you're comparing it to. So we just went 2012, I'll write it out for this one, $1,514,581 minus the previous accounting period we're comparing it to, so the 2.6 million almost. Okay. And that would give us our absolute difference. We'll put a comma here, okay, so that we can see what's going on. Okay, so again, this is just the comma. It adds commas so we can read this number a bit easier. So we're down. Remember, in brackets is negative. We're down. We can highlight this in red if we want. That's negative. That's not a good thing. Okay. So then we would go, now I'm going to use cell referencing because it should be easy. 2012 minus the previous year, and we're going to click and highlight, okay, and click and fill, sorry. Now that we're using cell referencing, we'll get rid of the zeros in between where we don't need them. Okay, you can use conditional formatting so that everything, top, bottom rules, highlight cells, less than. Okay, I'll just make it so that anything that's less than 0, let's just get red text. Okay, don't worry about that. You can learn that in DAT. So now anything that's less than 0, okay, it's going to pop up as red. So we see a lot of red. That can be good, it can be bad. Let's go find out what's good and what's bad. But first, let's actually do the relative change. So remember, relative change is going to be our absolute difference, okay, divided by the whatever you're comparing it to. In this case, we're comparing it to 2011, 25305. Okay. So it's our absolute difference, the difference between these 2 years, divided by the previous period you're comparing it to, or just what you're comparing it to. Could be a budget, right? Press enter, and this needs to be a percentage with 2 decimal points. Not good, right? So we're down 41%, 41.5% in sales. We went down by $1 million in transient rooms revenue. It's down by 41%. This is terrible news for this hotel. Okay? Now we're just going to use Excel, and we're going to divide our absolute difference divided by the previous period that we're comparing it to, and use the fill function. Okay. If ever you see the div even within your income statement, it's just telling you it's an error message. It can't divide 0 by 0, and the same thing here, so don't be too concerned. We do need to turn these into percentages. Okay, so negative numbers. These, when we look at revenue right here, this is really bad, right? Overall, we could just highlight all this and go, oh boy, what happened with our rooms department? We're in trouble here. Okay, expenses going down. This is a positive thing, remember that. But our total payroll went down by 5.66%. Our total revenue went down by 42%. We did not keep track. Okay, we only brought down our payroll by $27,635. Okay, this isn't good enough. Okay, if I went down by 42% compared to last year, my payroll should be going down close to that amount. Okay, now it's not always going to happen because we still need certain amount of people at hotels, and you know what, to keep track at a hotel with your decrease in revenue for a rooms department is fairly difficult. However, I'm not happy with this. Okay, overall, this whole area, we need to talk about our labor cost control. That's how you would find out for sure. Okay, you would take a look and you'd be able to see, okay, we're down 25,000, which is a decrease in 10%. So we tried to reduce labor, but our rooms revenue went down by 42%. This isn't enough. Okay, and then it actually shows again in our common size. So they complement each other in this case. If we take a look at our guest comfort, we've reduced expenses, good thing, right? And they went down by 47%. So we went down by total revenue by 42%, but we went down even quicker. So again, I'm going to highlight this in green and go, folks, great job. Okay. We weren't too sure about laundry revenue. We said, okay, well, it went down. It's pretty close. It went down by $30,000. It went down by 30% compared to 42. So it went down. We still controlled it pretty well. Same here, but we maybe could have controlled this a bit better. And that's how we would evaluate that. But overall, I probably wouldn't highlight it too much. I just talk to them and go, listen, we did a great job controlling it as much as we can. Let's just try a bit more. Okay? And then if you take a look here, this is a big problem right here. If you take a look, our revenues went down by 42%. So we should naturally expect a 42% decrease here. We actually experienced a 50% decrease in bottom line. That means that somewhere in here, in our expenses, we were spending more. Okay, so if we only had a 42% decrease in revenue, we should only expect about a 42% decrease in our bottom line, our departmental income. We had more of a decrease, sorry. So this number should be lower. Okay, we should have less of a decrease, which would make this less of a number. Okay, and we would have lost less money than we actually did. So you really want to take a look at your relative differences in relation to the room's revenue for this case. Okay. We want to look at whether or not our absolute differences are positive or negative, and remember which one is which. So positive for revenue is good, negative is bad. Negative for expenses is good, but only as long as we're keeping pace with our revenue. Okay, and it'll show up in our cost controls here in our common size percentages. Okay, so that's how you would analyze this income statement. Our summary operating statement. Okay, we'll just expand this. Now we're going to do quickly, okay, this part. I'm just going to do one or two. So we'd go our $3,027,118 divided by our total operating revenue. Okay, our 5.9 million almost. And if it shows up as a dollar, remember you're in Excel, click the percentage number, add two decimal places. Okay. We would do the same here, 2185, 539 divided by, and again, if you see a dollar, percentage, boom. Okay. Now let's just start using Excel to our advantage. We'd go our other operating departments divided by our total operating revenue. That's always for a summary operating statement. We won't go department to department. We've already done that in the departmental schedules. Okay. So for the entire summary operating statement, we're always comparing it to total operating revenue. That's the USALE way. Okay. So what I'll do is I'll undo that, sorry. All I did here is I divided my other operating departments to B16, which is my total operating revenue, and I'm making that my absolute function because when I use the fill function, I always want to divide everything by total operating revenue. Click and fill. Okay, you'll see that they all show up as dollars. While I have them all highlighted, I'll hit the percentage symbol and I'll add 2 decimal places. And then I'll go through my sheet and delete anywhere where there aren't actually numbers. As previously mentioned, if you didn't see what I did there, pause and go back. It's a video, take your time with it. We'll do the same here. We'll go our rooms revenue divided by my total operating revenue. We'll go an absolute function and we'll use the fill function. Highlight everything. Percentage symbol, 2 decimal places, and then let's get rid of some zeros. So how would we analyze this? So let's take a look at our revenue split starting off right here. So before, our rooms revenue accounted for 51.3% of our total rooms revenue. Now it's 52%. So that's okay. That's not a bad thing. It's fairly consistent. Food and beverage now represents 45%. So I'm going to go to my food and beverage team and go, hey, you're a bit busier than normal as a percentage of total revenue. Maybe this is good. Okay. We'll see. We'll be able to see later on whether or not we're happy with how they performed. Our other operating departments, what happened here? As a percentage of total revenue, this has gone down considerably. So I would want to know what happened at my hotel. Okay, why did other operating departments go down? And then overall, this is going to stay 100%. For my departmental expenses, my rooms, okay, and this is all compared to total revenue. As a percentage of total revenue, last year in 2011, my rooms expenses were 13.44% of total revenue. Okay, this year they're 19.33% or 19.3% of total revenue. So you would highlight this, but this is where we would need our departmental schedule. Okay, we'd compare them to total revenue, our rooms expenses, and go, this is a higher percentage than this. What happened? And then we'd be able to go back to our departmental schedule, analyze it, and go, oh, it's because of labor. Okay, so that's how they would work together. My food and beverage costs, remember I was happy about this number? Okay, well, I'm happy because it's a higher percentage. Okay, but if you take a look, my food and beverage cost, oh boy, as a percentage of total revenue, okay, it went up by quite a bit. I would want to look back at my food and beverage departmental schedule and find out what happened in these expenses. Was it labor? Was it food and beverage? What was it? Okay. My total operated departments, oh well, you know what? I've actually gone down as a percentage of total revenue, so this is a good thing. Total departmental profit, if we take a look, well, my departmental expenses went up considerably as a percentage of total revenue, so naturally my profit went down. Okay. Administrative in general, okay, again, we're going to see a lot of these numbers going up and down. So here, 11% compared to 6%. Oof, our administration, we didn't really adjust. If you take a look, we actually spent more even though we had less. Okay. Sales and marketing. Okay, this is good. Okay. However, the industry average is about 7 to 9% that you should be spending on marketing. So you know what? While I have a lesser percentage, this is not around an industry average, which means that maybe one of the reasons why this has gone down so much is my marketing. I marketed much less compared to my revenue, and we'll see in comparative how much less. Maybe this is a reason why I'm not making as much money. Okay. Property operation and maintenance, I'd be happy with this right here because compared to total revenue, I used to spend 12% or 13% of total revenue on operation. Now I'm only spending 9%. This is a great thing. Okay. And then utilities, this is something that you can control as much as you possibly can. But at the end of the day, you still need lights on, you still need to use water, so on and so forth. Management fees, notice how they're both 3.8%. Remember this management fee is typically a percentage of total operating revenue. Okay, so to me, this would mean that the contract is 3.8% of total rooms revenue is the management fee. So we can't really highlight that. We had no control over that. Property taxes, the only reason why these numbers are higher than these are because they're fixed expenses and we made less revenue. Okay? And then replacement reserve, you'll see that they're putting 20,000 one year, 30,000 the next. We had no control over that. But at the end of the day, our profit margin here, it used to be 23%. Now it's only 6.85% of our revenues. So somewhere in here, okay, and we can see where the bulk of it is here and these problems right here, we should have made 22.94. If we did that last year, we should have, even if we did 15% profit margin, this number would have been bigger at least. Okay. And then when we get to our absolute, and we can start from up here when we talk about a summary operating statement. Our absolute difference, we can go 2012 for our rooms, 45,458 rooms minus 45,124. Okay. We had a 334 room difference. We would do the same here. Okay, and we'll use Excel here. We'll go 2012 minus 2011. So that would be rooms sold. And then you know what? Let's just click and fill for the entire sheet. Okay, and then we'll just get rid of any zeros where there aren't numbers across here. And this one, and this one. And when we see any hashtags or pound signs, okay, remember it's just because it's not big enough. There's numbers in there, they're just too big. So we'll just double click. Okay, so right away, oh boy, we already know this, okay, but we're down. We're down in revenue across the board. We're not happy. Here we can see that we brought down our expenses and we have, this is all good, right? We brought down our expenses, but by how much? Is it enough? We already know that that's a no because our percentage of total revenue didn't go down well enough, okay? So that's why we can't just rely on comparative here. We need to also rely on common size and our relative difference as well. Total departmental profit, we know that's going to be down, okay? Administrative in general, revenues went down. Admin in general went up. Oh boy, this is terrible. Okay, I would be very upset right here. I'd be trying to figure out, well, what's the problem here? Okay. Now, the only thing with administrative in general, a lot of that has to do with your fixed salaries for your executive team. Okay, these are people that make a salary. It's fairly fixed, but there's also some parts of it that you can control a bit. So I would still highlight this and go, okay, we need to talk about this. Sales and marketing, it went down. Okay, and remember, this sales and marketing, sure, I'm happy I controlled my costs, but did this go down by too much? Am I spending enough money on sales and marketing to get revenue? Clearly, okay, I decreased my cost by way too much here. Okay, look at these two numbers. 3.68% of my total revenues is spent on marketing. Last year was 7%. 7 to 9 is the industry average, so I'm not spending enough on marketing. Maybe that's why that's like that, and that's probably the big problem here, as well as our other costs here. Okay, we didn't control them enough, but this is going to have a huge impact on my operations. This is a very big number. We decreased our costs for operations and maintenance by a lot, but we don't know percentage-wise by how much. My expenses went down, okay, which is good, but we don't know really whether or not it was good enough, okay, yet. We're going to do our relative difference first. Gross operating profit is good. Well, sorry, no, that's bad. We went down by 1.2 million, not a good thing. Management fees, you can look and go, oh, we controlled that cost, but it's a percentage of total revenue. So this only went down because total revenue went down. And same thing here, we can't really control these. So let's look at our relative change. So our relative change would be our absolute change divided by the previous year in this case. And then we want this to be a percentage. And we would just use our fill function. Okay, let's get rid of anything where there's no information on that line to make it look a bit cleaner. Okay, so we had an increase in rooms available. Okay, that would have maybe been an extra day. Maybe 2012 was a leap year. There's a number of reasons why this could happen. Now, rooms sold. Whew, we're down by 38% for rooms sold. That hurts. 4 percentages when it comes to your absolute difference. I'm going to put it down as a percentage. Okay. Because what this is going to show me is how many points. Remember, we talked about this in class. This would show that we were down 26 points. That's the difference between these two numbers. We're not going to call it a percentage because we start to get confused. Are we down by 26% or are we down by 39%? Okay. We're down by 26.5 points for occupancy, which represents a 39% decrease is how we would say that. Okay. Our ADR is down by, let's add a couple decimals because these are below 1,000. We're down by almost $6 for our average daily rate. Rooms RevPAR, we're down by even more. Same thing by total RevPAR. This is just overall bad. Okay, there's just nothing good about this. When we get to our revenues, okay, our total operating revenue went down by 43%. We can start to notice where that came from the most. So obviously my other operating departments did not help. A lot of it's going to be rooms, as we already saw. Okay, food and beverage didn't go down as much as our overall, but it also went down. So there's not really anything good here. Let's look at some big numbers here. Now, 18% decrease. We're going to say, yeah, this is awesome. This is great. It didn't go down as quickly as revenue. Okay, so this is where I would start to look back at my different departments. I would highlight this and go, okay, we've got to look at these departments. Because sure, we brought down costs, but we can tell that as a percentage of total revenue, I'm higher, and I didn't really keep pace with overall revenue. So let's go look at these departmental schedules and get some answers. My other operating departments, okay, this would be good, okay, but they also went down by 93% as compared to total revenue. So is it good enough? I'd look back at that departmental schedule. Okay. Departmental profit, that's not good. Okay. My revenues went down by 43%. My profit so far after my departmental expenses are taken out, I'm down by 55%. So I'm actually decreasing at a higher rate than this one. So that means in here somewhere I need to find some answers, and that's where the departmental schedules come into play. Administrative in general, we already know this is a problem, right, folks? So it increased, but my revenues decreased. I have some type of control over this, so I need to look back, and there is an administrative and general departmental schedule which will help me figure out what's the problem here. Okay, we'd have to look back at that. Sales and marketing, again, you might go, oh, this is no problem, this is great, we've reduced it so much. You need to market yourself as a hotel to make money. This right here would be a very big red flag. I've mentioned it a few times, but yeah, not happy. Property operation and maintenance, I've controlled this cost very well. Everything went down by 43.5%. My property operations and maintenance went down by 59%. I saved myself a lot of money here. Did I save myself too much money where maybe my hotel's starting to look a bit ratty or things aren't functioning as well, which then affects my occupancy? Maybe that's a reason too, but overall I saved money here. Okay? I would still want to make sure that my hotel is operating properly though. Utilities didn't keep track with revenues, but remember we can't completely control. We can only do so much, especially for a hotel. Gross operating profit, yeah, our profit again somewhere it's not good enough. It's gone down by even more than total revenues. Management fees, we can't control that. They've only gone down because again they're a percentage of total revenue. Okay. And because revenues went down, this went down. That's just something we have no control over. Insurance went down considerably. Okay, but again, this is more of a fixed expense. Maybe maybe I discussed with my insurance provider. I basically got a better deal on my insurance. I may have gone back and just discussed it with them and say, yeah, I'd like a better rate, or I change providers for my insurance. That's all that would mean. Bank charges, while that's a fixed expense, I'd still want to look into this. Okay, again, 0.76%, 0.26%. Those don't look like big changes, but it really represents 10,000 increase and a 62% increase in bank charges. I want to look into this a bit more. Why did we go up by so much? Even though it's a fixed expense, non-operating income and expense, I need to look into this. Okay, what am I doing wrong? Do I need to change banks if I'm being charged this much more? Because I had less revenue. Why do I have more bank charges? I'd want to look into this more. Okay, replacement reserve, that's a big increase, but necessary at some points. Okay, and then, well, yeah, we all knew this already. I'm down by 1.1 million. That's definitely negative. 83% decrease in my EBITDA less replacement reserve, my bottom line for my summary operating statement. I went down in revenue by 43.5%, but I went down EBITDA less replacement reserve by 83%. Somewhere in here, there's something bad happening. Okay, and we've already kind of highlighted them, and this is where we would go get some answers and go to our departments and go, okay, what's going on? How can we control these costs a bit more? And this one again, this would be my big one. I go, what happened? Why are we spending so much less on our marketing? Okay, and did it affect this revenue, which then would have affected everything else? Okay, so that's how you would analyze these income statements. I know it's very quick, but it's a long video. Pause it, go back, watch it again. Make sure you feel comfortable with both how to analyze a USAR and a USALI income statement.